Target date funds were supposed to be the set it and forget it miracle of modern retirement investing. But what if the miracle is mostly marketing? We need to talk about whether these all-in-one funds are actually beating the simpler, older, almost boring alternatives that your grandfather's financial advisor probably used. Let's back up and understand what we're even comparing here. Because most people throw money into a target date fund without realizing they could just be holding 2 or 3 index funds and sleeping just as well. A 60-40 portfolio, 60% stocks, 40% bonds, has been the bedrock of balanced investing since before most of us were born, and the 80-20 version is just its more aggressive, caffeine-fueled cousin. The pitch for target date funds sounds incredible on paper. One fund, automatic rebalancing, a glide path that slowly shifts you from aggressive to conservative as you age, and zero thinking required. But here's the quiet irony nobody puts in the brochure. You are paying for that convenience in fees, in over-diversification, and sometimes in surprisingly mediocre long-term returns. Vanguard, Fidelity, and Schwab have all published data showing their target date funds performing respectably. And yes, for the completely hands-off investor, they are genuinely better than doing nothing. But when researchers at institutions like Morningstar ran the long-term comparisons, a simple low-cost 80-20 fund frequently matched or outpaced target date funds over 15 to 30-year windows, especially when you account for expense ratios eating into compounding. Think of it this way. A target date fund is like ordering the chef's tasting menu when you actually just wanted a great steak and a side salad. You get a lot of courses, some of which you didn't ask for, and the bill is higher than it needed to be. The behavioral argument for target date funds is real, though, and we should not dismiss it. Studies consistently show that individual investors who self-manage tend to panic sell during downturns, which destroys returns far more brutally than any fee ever could. So the fund's value isn't always in its construction, it's in the psychological guardrails it puts around your worst impulses at 2 in the morning during a market crash. History gives us some humbling context here. The classic 60-40 portfolio was declared dead at least 3 times in the last 20 years. After 2008, after the 2020 bond rout, and during every inflation scare in between, and yet it kept quietly compounding for patient investors. The lesson markets keep teaching us, which we keep forgetting, is that simple and boring tends to win over complex and clever across decades. Here's a misconception worth destroying immediately. Many people assume target date funds are more diversified and therefore safer. But in reality, most hold the same underlying index funds you could buy yourself, just bundled together with a fee attached. You are not getting secret access to superior assets. You are often paying a middleman to hold hands you didn't need held. The practical lesson from all of this is frustratingly straightforward. If you are a disciplined investor who will rebalance once a year and not touch your portfolio during a crash, a low-cost 80-20 or 60-40 index fund portfolio will likely serve you just as well or better over the long haul. But if you know yourself and you know you will tinker, panic, or procrastinate on rebalancing, the target date fund's slightly lower ceiling might be worth it to avoid the catastrophic floor of emotional decision-making. Position sizing and consistency matter more than which of these vehicles you choose. Contributing regularly to either strategy will beat the investor who picked the optimal fund but stopped contributing during the scary years. The boring truth of wealth building is that behavior dwarfs structure almost every single time. There is also something philosophically interesting happening in this debate. We have built an entire financial products industry around solving a discipline problem that could theoretically be solved with a calendar reminder and a Vanguard account. The complexity we pay for is often just a mirror held up to our own distrust of ourselves. And sometimes the most rational move is to acknowledge that distrust and price it accordingly. If you are young, costs matter enormously. A difference of even 40 or 50 basis points in annual fees compounded over 30 or 40 years can translate into tens of thousands of dollars of real retirement income. Choose the simplest, cheapest structure that you will actually stick to. Because a suboptimal strategy executed with iron discipline crushes an optimal strategy abandoned in fear. Ultimately, whether target date funds or a classic index portfolio wins your personal long game depends almost entirely on your behavior, your costs, and your time horizon. And the fund that keeps you invested through the ugly years is the fund that wins. Discipline, sizing, and consistency are the actual alpha here, not the wrapper around your assets. If any of this has you rethinking your retirement strategy, your investment structure, or even how you are building wealth through real estate, we can help. Check out our links in the description below to get started with real estate investing, home contracting work, and finding lenders.